So what is happening with the banking system? I'm sure a lot of you are thinking the same thing. You're probably thinking, is this it? We got 3 banks now. You got Silicon Valley and 2 other banks that have gone public saying they're potentially insolvent. This morning, pre-market, you got other banks coming in saying, oh my gosh, our stock is down 65%. Run on the banks. Is this the next Great Recession or is it the next Great Depression? What does all this mean to you? Well, that's exactly what I'm going to cover. I'm going to dissect what happened with Silicon Valley Bank and what is going to happen with lots of other banks. I know the government stepped in and said, don't worry, we got this covered. We're going to give you all the money. I'm going to explain that, but I'm also going to explain where the opportunity lies for you. I've been talking about the opportunity for a while, but now it's time for you to wake up because this is the warning bell, but this is also the bell that means opportunity. My name's Chris Naugle. This is What Now? What's Next? So let's start with Silicon Valley Bank. Silicon Valley Bank started in 1982, very quickly became known as the startup bank for venture capitalists. I mean, being in Silicon Valley where all the tech startups are, well, why not plop a bank in there, make that bank specialize in startups, tech startups, founder startups, and all that good stuff, and venture capital will just come. And boy, did it ever. To the tune of hundreds of billions of dollars. And you know what? All has been well until 2020. So let me transition back to a time we all know and probably don't like, called 2020, the pandemic. 2020, the government printed about $5.1 trillion. The government didn't print it, the Fed did. But the Fed exchanged it to the government for what we call bonds, IOUs. And in doing that, a lot of money landed in your bank account, which you then, during the pandemic, because you couldn't go out and spend it, you couldn't get on planes, you couldn't go to restaurants, so what'd you do with it? You paid down debt. You saved money. Savings rates went through the roof. People started paying debts down at alarming rates. But also, you know who got the rest of that $5.1 trillion? Because it didn't all go to you. It went to the banks. So the banks had lots and lots of money. Oh, they were like, oh, they had all this money. And the money was so cheap. And they could just be like,
what are we gonna do with it? Well, we can lend it out to you, and we can lend it out to you, and we can lend it out to you, and oh, you need some of that?
And that's what they did. And when the world opened back up, we started borrowing a lot of money. We borrowed money for new cars, which we started paying more and more for because supply and demand. We started buying everything and the banks were lending us money and it was awesome, not gonna lie. It was a really cool time. The banks had all this money. And first thing you have to understand is how banks use money. You have to understand banking 101. Banks use what's called fractional reserve banking, which, just to keep it really simple, for every $100 you give the bank only needs to keep 10% of that money on hand in what they call tier 1 assets, tier 1 capital. Because, well, it's very rare that there's a run on the bank and the bank needs all this liquidity. So the bank takes that 90% and they just keep lending that back out, fractional reserve banking. But the 10% is really what we're going to talk about because the 10% is where Silicon Valley went wrong. And the 10% is also where lots of other banks are going to go wrong. But before we get into the 10%, let's talk about the 90%. Let's talk about what fractional reserve banking is. Let me show you. So what I'm going to show you is fractional reserve banking for a 5th grader. So here's you. Yep, you take your $100, you give it to the bank.
Here you go, Mr. Bank.
And the bank pays you interest on that money and you're happy. Oh, you're so happy. You got your 1 to 2% and the bank's got your money. So now what does the bank do? Well, the bank then takes that deposit, okay, the $100, they only need to take $10 of it, keep it in reserves. Keep your eye on the reserves for today, which means they got $90. That money's kind of made out of thin air. They got $90 that they're going to lend to Jill. Jill's gonna borrow that money at 5%. She's gonna buy those Nike SBs that she saw on Facebook, and she doesn't have any savings, so she's gotta borrow it. So she borrows the 90 bucks and she buys the shoes from John. Now John does what John's always been told to do. He puts the 90 bucks back in the bank. The bank then subtracts the $9 that goes into reserves. So now $19 is in reserves, but the bank's got another $81 that they're gonna have to make go to work. So the bank takes that $81 and they lend it to Billy. Billy takes out a loan at 10%. Billy's credit's not so good. And Billy pays off a higher interest rate credit card of 20%. So for Billy, he's paying 10. By paying off the 20% interest rate credit card, he saves himself 10%. Visa gets the $81. Visa does what every bank does, deposits it in their bank. So $81 goes in, but $8 goes up to reserves. Keep your eye on the reserves. $73 is then able to go out there and work for the bank. The banks all have what they call FDIC insurance. Now this started in 1929 when the Great Depression kicked in, because obviously that was a little bit of a problem, and it has worked really well. They guarantee deposits up to $250,000. Now, I want you to remember, most of the depositors, over 91% of the depositors of Silicon Valley Bank had balances over $250,000. Now, I know some of you are thinking, well, wow, that's crazy. Are people that wealthy? No. Who were the customers of Silicon Valley? They were businesses, tech startups. They had lots of reserves, probably millions of dollars in reserves that they just kept in the account. Because, hey, nothing like that had happened, and there's never been a problem until now. But I also want you to understand that the bank keeps records of all these loans, deposits, and reserves. But if we really were to then fast forward and look at what happened there, you put $100 in, Jill then got 90, Billy got 81, 73 was used, that was $271. That's right, your $100 deposit turned into $271 in fractional reserve banking fiat money. That's right. And they made interest on all of that money. But the one thing I want you to really focus on are the reserves. Now, the bank takes those reserves and, well, they have to put it in something that is guaranteed. So you've heard me talk about Bully, bank-owned life insurance. Yes, some of that money goes to Bully. Their long-term portion goes to Bully. But they also want to make money on the short-term money. They want all their money working for them because banks are smart, so they put that money in treasury bonds. Now let's transition back to Silicon Valley Bank. Silicon Valley Bank made a bet, and they took that money, that tier 1 money that would provide liquidity to the bank in the event of a bank run, and they put that money in treasury bonds, anywhere between 2 and 10 years. So let's just say it was an average of about 3 to 6 years that they had in these treasury bonds. The bank made a bet that, well, we're not going to have any big issues for 3 to 6 years, and we want to make some interest. And they made about 1.79% is the rate that they got when they bought those bonds right around 2021 to 2022. And they were not thinking that the Fed was going to go in and raise interest rates as quick as they did. But as we all know now, last year, 2022, the Fed raised interest rates 7 times. And in 2023, we just got started. This is March 2023. They've raised rates once, and we know they're going to raise them a lot more because, well, Jerome Powell from the Fed has said they're going to. So what happens when the Fed raises interest rates? Let me show you. So let me now show you something that I've been teaching you all for the better part of over a year. And some of you have listened, well, some of you have not. We've been talking about treasury bonds. That's right, those IOUs that the government can give you. You know, you give the government money, they give you an IOU and they pay you interest. It's called treasury bonds, guaranteed by the full faith and credit of the U.S. government. Now remember, Silicon Valley Bank bought treasury bonds with that tier 1 capital, with that money. They took a bet. The Fed wasn't going to raise rates, but the Fed did. So what happened? Well, those treasury bonds that they bought way up here from a price standpoint have an inverse relationship to interest rates. So if interest rates went up, as shown right here, so if interest rates go up, the price of the bonds go down. Got that? That makes a unique opportunity for you, because as interest rates go up, the price goes down. When do you want to buy things? When the price is going down. When do you not want to sell things? When the price is going down. Silicon Valley Bank had a little issue. You see, they knew they were getting into a little bit of a crunch when it came to money because of this. And because they got into a bit of a crunch, they started looking to sell the bank, which it was a very sellable bank. Until, well, the media got a hold of this and started to say, Silicon Valley Bank is going to go insolvent. Silicon Valley Bank is having problems. As soon as that hit, guess what all the depositors that have money at Silicon Valley Bank wanted to do? And folks, this was just last week. It's called run to the bank. There was a run on the bank. And everybody went to the bank looking for their money. Silicon Valley Bank didn't have their money because why? Well, their money was in bonds that had gone down in value. So what did the bank do? They sold those bonds. They sold a lot of those bonds and took about a $1.9 billion loss on those bonds. Now that's a pretty severe loss because if they bought them back in 21, 22, and interest rates went way up since then, the price of the bonds went down and they sold about right there. Not so good, okay? But they played the game for the interest rate that they were going to get on those bonds. But here's why Silicon Valley Bank didn't think they had a problem. Because banks are in the business of taking your deposits. But unfortunately, Silicon Valley Bank was in the business of working with tech companies, startup companies, venture capital companies. Now, if you've been paying any attention, the NASDAQ and tech companies have been going down, 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 which means they don't have as much money to deposit in the bank. So when deposits slowed down and Silicon Valley Bank had more and more people wanting to take money out of the bank, they couldn't keep up. And that's where the buck stopped. And that's when the regulators had to step in, take over the assets of Silicon Valley Bank. Now, what you haven't heard is right before this news broke, the executives of the bank all got big old fat bonuses. I kind of remember that from 2008. I remember a lot of bank executives getting paid huge bonuses right before their bank went insolvent and out of business. Washington Mutual. Well, Silicon Valley Bank just happens to be the second largest bank failure in history. And it isn't going to stop here, folks. It's going to continue. And how are you going to play this game? We're going to cover that in a second. So when the news hit about insolvency, about people not being able to get their money, about the bank closing, it sparks fear. Not just fear of Silicon Valley depositors, but fear across the entire banking system. You see, I don't care what bank you have your money, I bet you anything that you are starting to think, is my money safe? But then Sunday, when the Fed made the announcement that the money was safe, they were going to make all the depositors whole, and it wasn't going to cost the taxpayers any money. What they were going to do is just tax or take more money from the banks. See, right there is another problem that we're going to cover in a second. You see, there is no free lunch. Depositors that put money in Silicon Valley Bank above and beyond $250,000 knew the risk. FDIC is very clear about $250,000 is that's what's insured. Anything above that is not. But now all of a sudden, Robinhood, the government, steps in and says, hey, we're going to make everybody whole. Now, I'm not saying that's a bad thing. But again, I keep saying this over and over. Where does it stop? Where do you draw the line? Where do people like you, me, and the tech industry and the tech people, where do we have to understand that the risk falls on us? Because we don't live in a country, in a society where every mistake we make should be bailed out by the government. But it seems to be that that's what the government wants to do. Could it be because they're trying to protect something much bigger? Maybe bigger cracks in the foundation? I guarantee it. Let me read you a couple things that should open your eyes. You see, Forbes, we all know Forbes, in 2023 did a big article on how Silicon Valley Bank was one of the best banks for the 5th straight year. Did they pay for that? Or did Forbes really not do their due diligence the way they should have? Cracks in the foundation. Let's keep going on. The Board of Governors of the Federal Reserve System on 3/10 advance notice of meeting under expedited procedures. A closed meeting of the Board of Governors of the Federal Reserve System will be held under expedited procedures at 11:30 a.m. on March 13th. That's Monday morning. Matters considered, review and determination by the Board of Governors of the advance and discount rates to be charged by the Federal Reserve banks. You may not know what that means, but you will very soon. How about Peter Schiff, a well-known economist? He did a tweet saying the U.S. banking system is on the verge of a much bigger collapse than the 2008 Great Recession. Banks own long-term paper at extremely low interest rates. They can't compete with short-term treasuries. Hold on, let me explain that. You've heard me mention the inverse yield curve. The inverted yield curve is not good. That means people are getting paid more to own 2-year treasuries than they are 10 or 30-year treasuries. That's backwards. That's what Peter's talking about. And he said that mass withdrawals from depositors seeking higher yields will result in a wave of bank failures. And I find this one incredibly funny. Ming Ling Tan, sorry if I got that wrong, I think Twitter should buy SVB and become a digital bank. Elon Musk says, I'm open to that idea. Woo! Yes, Elon. Bring the heat. So Silicon Valley Bank got shut down by the regulators. And Sunday night, the government stepped in and said every depositor is going to be made whole. But they didn't say every depositor of every bank in this country that's going to have problems is going to be made whole. They said every depositor of Silicon Valley Bank will be made whole. And how will they get their money back? Well, it's not going to come from the taxpayers, so they say. That's what they always say. It's going to come from something else. What is that going to be? Well, the regulators and the FDIC will take control of the assets of Silicon Valley Bank, and they will sell those assets off. Now, for future banks, what they've done is they've created short-term loans that they're going to give to banks that need short-term money because there will be runs on the bank. So now banks can go to the government and the Fed and take short-term loans. And the banks can put up those long-term treasuries, those 2, 10, or even 30-year treasury bonds that they bought as collateral. Now, this is a really good solution. But again, it is a temporary solution. And if this problem continues, if more and more banks start to show insolvency problems because we thought our banking system was so strong, we're all going to really feel the pinch. But you know what? I think we're too far past this. I don't think there's any saving this economy. I don't think there's any saving us from this recession or what Peter Schiff is calling maybe the next Great Depression. So let me give you just a couple quick pointers on what you can do to get your money safe. So behold the 3 cups. You all know this game. You know it. They used to put a marble. Sometimes they put a rabbit in there and they move the cups around. You remember it? They'd do like this. All right, follow the rabbit, follow the cups, follow the, where one's the marble in? Where is it? Where is it? Yep. Okay, but now we're not going to talk about marbles or rabbits. We're going to talk about your money. Your money right now might be sitting in one bank. Because why? It's convenient. Just look at the people at Silicon Valley Bank. They had millions of dollars. Over 91% of their depositors had more than $250,000 in the bank. All the risk was in one bank. Now, what should you do? You should do the exact opposite. You see, you shouldn't keep all your money in one bank. You should actually take some of it and put it in another bank, and some of it in another bank. And I should have more cups, but we're just going to do 3. You should diversify the money in the banks. Why? Because, well, number one, we all understand FDIC only guarantees up to $250,000, but you know what else it comes down to? It comes down to you will need liquidity in this next economic cycle. Because your liquidity, your money, is going to provide you the ability to take advantage of opportunities. But those opportunities will dry up if all your money's in one bank because something can happen to that one bank. Your money might go away. Maybe that one bank is where you have your home equity line of credit, and when you want money, you take the home equity line, and what do? You put it in the bank account where your home equity line is. And then the bank calls your home equity line or freezes it. They're just going to take the money back and put it in their account, not yours. And now you got nothing, and now you're wondering what happened. So here's what I like to do. I like to play the cup game, the shell game. So what I'm going to do for today's little experiment is I'm just going to take the money and I'm going to put it in this cup. Okay, you all see all the cups are the same. Okay, there's no tricks here, no magic here. Now, all I want you to do is I want you to pay attention. This is where your money is. Pay attention, folks. Keep watching, keep watching. Okay. don't even know where it went. Where's your $100? Which bank's it in? Is it in this bank? Nope. So they were looking for your money. They couldn't find it. Is it in this bank? Whoa, it's not in that bank either. So it must be in this bank. There's my money. But you see, all we did is we played the shell game. We diversified banks. So how do you do that? Oh, it's so simple. You know what? Take one of those sick days or those days that you just say, oh,
I think I got COVID, I can't make it into work.
yeah, you don't have COVID. You're just making an excuse because you're being lazy. Sorry to call you out. But what I want you to do is on that sick day, quote, I want you to take some time and I want you to go out there and I want you to go to a couple banks. Start with the bank where your money is. And I want you to take some of that money out and I want you to go open another account with a community bank in your town. That's right. And what we're going to do is we're just going to take some of your money and we're going to put some of your money in that community bank. You're going to open up a new bank account. You're going to build a new relationship. So now we've got money in two banks. Then what we're going to do is we're going to take some money out of that original bank and we're going to put it over into a credit union. That's right. So now we've got a community bank, your commercial bank, and a credit union. We're diversified. So now your money's split up. You have less than $250,000 at any one bank. You tracking? And if you have a home equity line of credit and you happen to take the money out of that home equity line of credit to, well, do some of the things I teach you to do, don't put it back in the bank account that your home equity line was issued by. Take that and put it in one of those other banks. So now when this bank that issued your home equity line of credit comes a knocking saying, hey, we're going to freeze your line, can you pay it back? Sorry, I don't have any money. You do, it's just in another bank. Follow? Great. All right, so the second thing I would suggest you do is be your own banker. Yes, it's a skateboard, but you know what? Very true about that. If you just learn how to do what the banks do, but you do it yourself, you're a lot better off. And you know who else understood this? The Rothschilds, the Rockefellers, the Morgans, the Stanleys. That's right. Back in their time, they had a lot of money. But they didn't trust the banks. Like, well, you probably don't trust the banks right now after what you just saw happen. So what'd they do? They found a safer financial institution to store their capital. And where'd they land? Giant, mutually owned insurance companies that pay dividends. And that was then, and we can fast forward all the way till now, it's still the safest place to put your money. Because insurance companies practice Austrian economics. They don't do this fractional reserve banking nonsense. So the money that they have, well, they actually have it. Yeah, they don't have to go out there and do the things that banks do and risk money and take bets on Fed not raising rates or Fed raising rates, as I discussed. And if you just stick around and you just follow what I'm teaching you, you will not make those mistakes. Because when you become your own bank and you are an honest banker, your money will always work for you and you will control it all. So folks, my final message to you is it's time for you to take back control of your money. And it's time for you to do that by taking back control with being your own bank. My name's Chris Naugle and thank you for joining me for another What Now, What's Next. Hey folks, if you liked this video, check this one out right here. BYO Bank. It will teach you all about the infinite banking concept and how you can be your own bank. See you next time.